Welcome to the Deep Dive. We're here to cut through the noise and give you the core insights from key market updates.
That's right.
Today we're jumping straight into Alpha Metallurgical Resources. Their first quarter 2025 earnings call just happened.
Yeah, and the headline really is that it was a challenging period for them.
Definitely looks that way. Adjusted EBITDA, what, $5.7 million?
$5.7 million. And they shipped 3.8 million tons of coal.
And just to give everyone some context, that's down quite a bit from the previous quarter, Q4 2024.
Oh, significantly. Back then, it was $53 million in adjusted EBITDA and 4.1 million tons shipped. So, yeah, quite a difference.
So what was the main driver? Lower met coal prices obviously played a part. But what else happened in Q1?
Well, it was kind of a perfect storm, unfortunately. Operationally, the weather in January and February was just brutal.
Oh, well, right.
Yeah, caused all sorts of problems. Lost shifts because people couldn't get to work, power outages at the mines, and then just the direct impact, snow, ice, flooding. It really hampered things.
And that impacts transportation too, I assume.
Exactly. Big time. Delays getting the coal out, issues at their DTA facility, which is, a crucial export terminal for them.
So weather was a major factor. Anything else on the operational side? Yeah,
beyond the weather, they also mentioned some geological issues cropping up in several mines, sort of independent challenges.
Yep.
The slight silver lining, I suppose, is that their cost of coal sales did start to improve in March and April once things settled down a bit.
Okay, so operational headaches. But the market wasn't exactly helping either, was it?
Not at all. Met coal prices, the indexes, they stayed pretty low through the whole quarter.
And that's tied to steel demand?
Primarily, yeah.
Yep.
Global steel demand is just weak. And then you layer on top this growing uncertainty about tariffs, trade policies changing. It adds complexity.
Makes sense.
So Alpha is basically saying, look, we're cautious for the rest of 2025. Unless the global economy really picks up, these pressures are likely to stick around.
So faced with lower prices and operational hits, liquidity becomes key, right? Protecting the balance sheet.
Absolutely paramount. That's been their clear focus.
What steps have they actually taken?
Some pretty significant ones. They've had to make difficult decisions like cutting production at some of their higher cost operations.
How much production are we talking?
About 500,000 tons annually. They're idling that capacity.
Okay.
They've also had to reduce wages across the company and close the Long Branch surface mine in Virginia, plus idled a part of the Judy Fork mine in West Virginia.
Wow, those are serious moves. What about the workers?
They did mention they're making efforts to place impacted miners in other roles within Alpha, which is, good to hear.
Right, trying to manage the human costs. So these actions, the production cuts, that must mean they've changed their outlook for the full year.
Yes, exactly. They've lowered their sales volume guidance for 2025.
Okay.
They're now expecting to ship around 15.3 million tons of coal at the midpoint. That's down 1.4 million tons from what they originally thought.
And capital spending. Usually that gets a trim too in times like these.
Yep. CapEx guidance is down too, cut by about $27 million at the midpoint. The new range is $130 to $150 million.
Does that impact any major projects? What about Kingston Wildcat?
Interestingly, no. They stress that Kingston Wildcat remains on schedule. They found about $8 million in savings for this year's budget, mainly by doing some work in-house instead of contracting it out.
So that project's still moving forward?
Yeah, they still expect to start taking development cuts in coal there late this year, and then ramp up towards about 1 million tons a year in 2026. So that's still a key part of the plan.
Good to see strategic investments continuing. Now, I also saw they amended their ABL facility. Can you quickly explain what that is and why it's important?
Sure. An ABL, or asset-based lending facility, it's basically a line of credit secured by the company's assets like inventory, receivables. It gives them flexible access to cash.
Right.
And what Alpha did was increase the size of this facility from $155 million up to $225 million. And there's potential for another $75 million on top of that. Okay, some more borrowing power.
Exactly. Plus, they extended the maturity date out to May 2029. So it gives them more breathing room, more liquidity, more options, basically.
Yeah.
Very helpful in this kind of market.
Makes sense. Let's dive a bit more into the actual Q1 numbers. We know EBITDA was down, shipments were down. What about the prices they actually got for their coal?
Yeah, the realizations took a hit. In the met segment, the average price per ton dropped to $118.61. That was down from like $127.84 in Q4.
Okay. And does it very much depending on where it's sold?
It does. Their export tons priced against Atlantic indexes got about $119.39 per ton. But the ones priced against Australian indexes only got $107.44.
Interesting difference.
Yeah. So the total weighted average for all their met coal sales in Q1 ended up being $122.80 per ton. Again, down from $132.63 the quarter before.
And the thermal coal they sell, incidentally.
Yeah, that actually ticked up slightly. They got $79.39 per ton for that.
But cost went up, right? You mentioned the weather impact earlier. Cost definitely went up for the Met segment, reached $110.34 per ton. Mostly weather, what we discussed.
Okay. Any other financial highlights? SG&A. CapEx spend in the quarter. Cash.
Let's see. SG&A actually decreased down to $12.6 million. CapEx for the quarter itself was $38.5 million. Their unrestricted cash pile did shrink, ended March at $448 million.
But overall liquidity, including the ABL?
Total liquidity was stronger, $485.8 million at the end of March, but cash from operations was way down, only $22.2 million for the quarter.
Reflects the tough conditions. And just to recap the updated guidance for the year, shipment volumes.
Right, revised down. Met coal shipments now expected between 13.8 and 14.8 million tons.
And thermal coal sales, 800,000 to 1.2 million tons.
Do they have much of that locked in already, price-wise?
Yeah, pretty good visibility, actually. At the midpoint for met coal, about 50% is committed and priced already, averaging $133.40. Another 45% is committed, just not priced yet.
And the thermal.
Thermal byproduct portion is fully committed and priced, average of $80.75.
And share buybacks, did they do any in Q1?
Nope.
No share repurchases in Q1. They cited the market softness, holding on to cash.
Makes sense. Operationally, then, Q1 sounds like it was just about weathering the storm, literally.
Well, pretty much. Costs spiked because of the weather and those geological issues in some underground sections.
Any sign of improvement since?
They did say March showed better cost performance, and they expect that to continue into Q2, especially with the cost-cutting measures and those wage reductions they implemented kicking in.
Right, the market-driven pay cuts.
Yeah.
Aligning costs with the weaker market.
Exactly.
Okay, let's pull back a bit. The wider market picture. Met coal still under pressure.
Yeah, the dominant theme is still that weak global steel demand. It's just keeping a lid on things.
And the trade uncertainty you mentioned?
That's just adding to the volatility. Makes planning difficult, you know. All the main met coal price indexes fell quite a bit in Q1. The Aussie Premium Low Vol Index got hit hardest, down over 15%.
Ouch. Have things picked up at all since the quarter ended?
There's been a little recovery in the indexes in recent weeks, yeah. But the feeling is that might be due to sort of isolated things, not a broad improvement. The bigger economic picture still looks weak.
Right. The IMF forecast, the tariff impacts.
Yeah, the IMF is talking about a global slowdown, partly because of these new U.S. tariffs, potentially higher inflation too. It all feeds into that cautious outlook.
Any other specific market points? Vessel fees. DTA.
Alpha had expressed some concern about potential new vessel fees related to a U.S. investigation into China's shipping sector. But apparently the revised guidance on that exempts empty vessels, so they seem less worried now.
Okay.
And yeah, the DPA export terminal is currently down for a couple of weeks for planned maintenance and upgrades. Should be back to full capacity around mid-May.
Got it. Okay, let's shift gears slightly. This is where we say this is not financial advice.
Definitely not financial advice. For illustrative purposes only.
Exactly. But based on all this, what's an outrageous but plausible trade idea you've been thinking about?
Okay, here's one. You've got Alpha cutting production significantly, right? And you've probably got smaller, maybe less financially stable competitors really feeling the squeeze, potentially cutting back to or even going under.
Right. Supply could get tighter than expected.
Exactly. Now, what if, and it's an if, global steel demand suddenly snaps back much faster than anyone anticipates? Maybe some big surprise infrastructure spending or trade tensions ease unexpectedly.
Okay.
Well, with reduced supply already baked in, met coal prices could rocket upwards, catching the market completely off guard. So a contrarian long position in Alpha could potentially pay off handsomely.
High risk, high reward potential. Needs a tight stop loss, you'd think.
Absolutely.
Yeah.
You'd need strict risk management. It's betting against the current trend.
Okay, outrageous idea number one. Give us another one.
All right, think about that expanded ABL facility Alpha secured. More cash, longer runway.
Increased flexibility.
Right. Now, compare that to potentially distressed competitors. If this weak market drags on, some smaller players might be forced to sell assets cheap just to survive.
So Alpha could become a buyer.
Potentially. They could be strategically positioned to pick up quality assets at bargain prices thanks to their stronger liquidity position.
Like a consolidation play.
Sort of, yeah. So a speculative long in Alpha could be seen as a leveraged bet on them successfully playing the role of consolidator when the cycle eventually turns. But again, big risks.
What kind of risks?
Well, M&A is always tricky to execute well, and the market downturn could last much longer than expected, draining even Alpha's resources eventually. So again, highly speculative.
Understood. Both definitely fit the outrageous but plausible category.
That's the idea. Food for thought.
All right, that wraps up our deep dive on the Alpha Metallurgical Resources earnings call. We've tried to pull out the key pieces of information for you.
Hopefully giving you the context without all the fluff.
And just one more time, those trade ideas. Purely illustrative, not advice. Do your own homework.
Always do your own research before making any investment decisions. Crucial.
Let us know what you thought of this analysis. And tell us what other earnings calls or market events you'd like us to tackle next time.